Hey traders, Akil here. Welcome back to another Trading Edge video. It is Tuesday, June 12th, about 2:30 p.m. New York time, and two pairs I want to take a look at today. Now, if you've been involved in the markets, first and foremost, welcome to summer trading. Expect a lot more like this. It's going to be very slow days. However, that doesn't necessarily mean that there will not be trading opportunities. One of the things that I reminded our traders in the live room this morning is that it's very important that we still go through the correct routine. So even if we wake up and we think we're under the assumption that the markets are going to give us nothing, it's still important that we go through our portfolio, we do our correct analysis, because you never know when there's going to be a trading opportunity that is under the radar. And I'll tell you what, more so in the summer, but in general, I'm just looking to get one good trade a day. If I can find one good trading opportunity, that can make my day. And especially when the trading opportunities become less frequent in the summertime, it's more important that we try to avoid those misses. Now, this is a big week of news. We've made it past today already. Tomorrow, right? Wednesday and Thursday are our two major days. You can see here on the news radar for tomorrow, Wednesday, we have our FOMC economic projections, FOMC statement, federal fund rate, and press conference. And essentially what is happening is that the interest rate is going to get hiked. At least there is a 99.99999 chance that it's going to happen. Now, many of you, we had another good conversation. In fact, I'll plug in the conversation we had on this topic in the live room at the end of this video, talking about how the interest rate hike doesn't really matter. The market's already priced that in. But you do want to be aware of the FOMC press conference, because what the market is looking for is what's next. Will we see a fourth rate hike? Will we start easing up on the aggressiveness of our hiking cycle? Will we stop the hiking cycle just like that? Who knows? The market will be looking for any type of hint or clue about what's to come next, and that's what it's going to base its decision off of. The rate hike that is coming, or that we're 99% sure is coming, has already been priced in for a long time now. Then, on the next day, we have our ECB press conference, where the main topic is going to be quantitative easing. So we get two back-to-back days of major news events, and press conferences are always a little bit different, because they typically have open Q&A, which lends for some unscripted answers, and that can always shake the market. So these next couple of days are going to be big. I believe we have some monetary policy statement coming out of Japan on Friday. There you go, BOJ press conference on Friday as well. So, like I said, interesting day for news. I'll put in the clip talking about tomorrow's interest rate hike at the end of this video. But what I want to look at today are two trading opportunities, one on the dollar yen and the other on silver. And the dollar yen, if you guys remember, this was a pair that we talked about a long time ago, right? I'll take you for you guys that have been with us for a while. I'll take you all the way back to our ascending triangle. A little bit hard to see on the daily right here, but we had a very nice trade setup right here where we expected a breakout. And the ultimate destination that we expected for that breakout was 111.50s. And we came very close to that. We came about 2 pips before seeing the market reverse, right? Now, the market reversed. However, we never violated our previous level of structure. So if you look at this, right, the bottom of our ascending triangle as being our previous structure lows, we never violated that level. We prodded and we probed it, and we tried to do little sneak attacks down there. But each time price action tried to push beyond that level, you can see the wicks on these three candles, the buyers were able to push it back up, right? Sellers went lower right here, buyers push it up. Sellers couldn't get as far down, buyers push it up. Sellers, for a third time, couldn't even get as far down, right? Very similar to what we're seeing right here, where we see the ascending slope in the wicks. If you guys look very close, you can see this, right? Look at these three candles. Lowest wick, middle wick, highest wick, lowest wick, middle wick, highest wick. Guys, look left. Structure leaves clues. It's right here. The market leaves us clues. And we saw a big rejection off of that level and some more buying pressure. It did look like we can put in the head and shoulders, and that was something that was on the radar for you guys that have taken the head and shoulders course, right? One of the entry reasons that we talk about is an entry at the right shoulder. However, what do you remember me saying about looking to enter at the right shoulder? If you didn't take it, obviously this question isn't for you. But for you guys that took it, what do you remember me saying about the right shoulder? Right? The right shoulder entry is the most aggressive entry for the head and shoulders pattern. Why? Because it's entering a trade that isn't really a trade. And what I mean by that is, although we're predicting this to be a head and shoulders, it is not technically a head and shoulders pattern, right? Left shoulder, head, right shoulder. It is not technically a head and shoulders pattern until the neckline is tested. So if you're looking to enter at the right shoulder, you're entering before the pattern is complete, right? So although we had a head and shoulders on our radar, we never actually had that head and shoulders completion. And now it looks like our right shoulder is either pushing higher, or we may not have a right shoulder at all. So the question is, if price action is going to continue to go higher, where are we likely to go higher to? And well, this just goes back to our original prediction. Again, going back to our ascending triangle right here, our original prediction was 111.50s. We went up to 111.50s, a little bit below that actually. We went up to 111.50s. When we found resistance, I would not be surprised if price action put in a retest of this level and gave us another decision point. So as a structured trader, right, as a counter trend trader, this is the level where I would be looking to get involved, right? So we identify, we predict it. Now let's use the rest of our analysis to kind of build our case for entry, right? We take a line right here, swing low to swing high, right? We can copy and paste this. I'm a $yen on the daily, by the way. I forgot to say that. Copy and paste that line, draw it on to the bottom of our most recent retracement, and this is going to be called an equal measured move, or an AB equals CD pattern, where this first leg is the A to B, this retracement right here is the B to C, and then our projected extension is going to be the CD completion. And you can see that if we do get that one-to-one measured move, that AB equals CD completion, that's going to put us right up in this zone. So counter trend traders, you can look for a move into this zone and then look for your reason for entry, whether it's a single candlestick formation, multiple candlestick combo, a simple candlestick pattern such as a double top, a 2618, what have you, whatever your entry technique is. Look for that counter trend trading opportunity here at this level. And if you are a trend continuation trader, what do you think you should be doing here? If you are a trend continuation trader, what you're waiting for is the violation of this zone. So you're waiting for price to tell you that our previous level of structure resistance was violated, broken, and then you're getting into pullback mode or I guess if you're a breakout trader, you can trade it on the breakout on the way up. That would be an opportunity to get involved as well. But I know a lot of you guys are pullback traders. So you're waiting for price action to pull back in the previous structure. You're going to create your kill zone, and we'll go into more detail about this if it happens, of course. But you're looking for a buying opportunity if this level is violated. So that's a longer term look at the $yen. Again, I want to give you something longer term, mainly because, well, we have big news coming out tomorrow, so there's anything short term is probably going to be a waste of time. But also, again, I understand that many of you guys aren't day traders. We do enough day trading opportunities on in our live room sessions, right? I want to give you guys something that you can look at days in advance, something where you can come into your computer screen early in the morning before work, set up your trading opportunity, go to work, and not have to worry about watching the chart every 5 minutes for your trading opportunity. Something you can kind of do during your pre-market analysis and then maybe check on it once a day. So that's an opportunity here on the $yen. Let's go to silver next. Silver dollar XAG. I'm used to gold XAU, XAG USD. And we're going to stay here on the daily chart. And you're going to see that silver has been in, well, let me ask you guys, what do we call this? For you guys that are on a trial membership, you've taken the emergence course. You should know that the market moves three ways. And I gave you guys 3 tricks, right, on how to view the markets, right? If we're going from bottom left to top right, we are in a what type of trend? If we're going from top left to bottom right, we are in a what type of trend? And if we are just going sideways across your screen, which we are doing on this chart, we are in what's called consolidation, and we are in a period of consolidation here on silver. Now you can look at this a few different ways, right? You can look at this as a kind of a bigger pattern and a smaller pattern. The bigger pattern here on silver is that we are in this, you can call it a triangle or wedge pattern, either way. I'm just going to ignore this spike down here, but you can see our range is getting smaller and smaller. So where the market's giving us kind of a coil, where at first the range is big and then it's getting smaller and smaller until ultimately we see what's happening right here. If we zoom in on that even more, right, you can see kind of a similar aspect where we have this top trend line, and you can adjust trend lines to how you want. I'm not too big on trend lines, so don't shoot me a message about, Akil, your trend line wasn't exactly touching the top. I don't really care. I'm just using this to kind of show you guys the overall pattern of the market. But you can look at this top trend line being right there, and then you can look at the bottom one being right here, and this is going to be more of a descending channel as well. And you can ask yourself, well, what's interesting about this is that each time, right, we put in a high, what is happening? Our highs are getting lower and lower and lower and lower, right? And if we look here, and we're projecting a move right here, we just broke previous structure. If we're projecting a move higher, and we may be projecting or anticipating a lower high as well, right? Then we would expect this level of structure up here to hold, right? To act as resistance. And this is where we can bring in, right? Because we know that consolidation leads to pattern formations. We can bring in our Fibonacci tool. We can measure out our swing high, our most recent swing high to swing low right here. And we can see that price action comes just below the 618 Fibonacci retracement. Now, I'm a trader that has strict rules when it comes to my pattern formations. And I know not everyone trades them like that. Not everyone teaches them like that. But I find that when it comes to newer traders, well, one of the main reasons traders fail is psychology. One of the main reasons traders struggle with psychology is because they don't really have clearly defined rules for how they're trading. They give themselves a lot of wiggle room to kind of interpret the market. And that's a double-edged sword, because what I found is that as you become more experienced as a trader, you do need to have that room to interpret the market a certain way. Now, that should be within a guideline of rules, but trading is both an art and a science, and every artist needs kind of the freedom to interpret something. So it's interesting, but as a newer trader, you're more like a little kid, and I don't mean that to offend, but you can't always trust the little kid to make the best judgment, to make the best consistent judgment. So as a little kid, you need to have strict rules on what you can do and what you can't do. Then, as you get older, you have more room to be flexible. And not to get on a long rant, because you know I'm a sports nerd, guys, but there's a great example of this with like NFL quarterbacks. I think I did a trading coach podcast on Ben Roethlisberger or Tom Brady, where when they're rookies, right, the coach has control over the play signals or the signal calling, and then after you've spent 10 years in the league and you're really comfortable with what you're doing, basically you have the ability to change the play at the line of scrimmage, to make audibles, to make your own reads, and all the rest of that stuff. And trading is the same way. But the point of that is, with advanced pattern formations, I don't have a close enough rule. I don't have any rule that says, well, if it's in the range of the 618, if it's close to, because close to is going to end up being whatever you want close to be. If it's a situation that you want to take, oh yeah, it's close to. If it's a situation that you don't want to take, well, it wasn't close enough. And then which one is it? And there's nothing wrong with creating a close enough rule, right? It's obvious that if price action here is closer to the 618 than it is to the 50% retracement, but just put in a rule for it, right? Close enough equals 5 pips, within 5 pips. Close enough equals within 3%. Whatever you want it to be, just put in a rule for it, and now you have a rules-based close enough rule, if that wasn't enough rules for you. But because we don't hit the 618, what I'm looking for here is a potential bat pattern, and that's going to look something like this. Let's just take this tool out so we can draw it on. We're looking at an X to A to B, B to C, and then a CD completion up our 886, up at our 886. You can see it's right within that box we drew out. It would be a lower high, which is kind of what the trend has been, and we are in consolidation, so we're looking for choppy movement, all right? And pattern trades are typically counter trend trades, so all you're looking for is a little bit of a retracement back in the structure there. So a decent opportunity on silver dollar as well, a decent opportunity on dollar yen. And now I'll leave you with a little conversation we had in our live trading room this morning about tomorrow's interest rate hike. Troy says 99% rate rise for tomorrow. Would that not indicate dollar strength and down? Nope, it would not. Do you know why? And this presents a very good lesson. So I'm glad you brought that up, Troy. Who knows why it would not? And this is why they call them funny mentals, right? And this is a mistake that I used to make as well when I used to be. When I started in the stock market, I was a fundamental trader in the stock market. And I was an investor, so it was a little bit different. But, I'm reading reports and all that fun stuff and making my investment decisions off of there. I attempted the same thing, or I didn't necessarily attempt the same thing when I came to Forex, but I kind of made the same assumptions where it's like, okay, well, the basic principles of economics, right? And Troy kind of mentioned it, right? When a currency gets a hike in its interest rate, it should show strength, right? Would you guys agree? Basic principles? Interest rate goes up, strength in currency. Interest rate goes down, weakness in currency, right? That's typically how it should go, the obvious. Unfortunately, the game being played is by people that are much, much smarter than us. And what happens is most newer traders are late to the party. So we have that idea, Troy. The problem is we're too late. And something I realized in the market is that the market makes, what's the old saying? Buy the rumor, sell the news. Perfect example. Buy the rumor, sell the news, right? So the interest rate hike tomorrow, like you said, 99% sure that we're going to hike our interest rate tomorrow. Now, when do you think that was known? How long ago? A couple days, a couple weeks, a month, right? Probably a couple months ago, right? What the market does, what the smart investors do is they're already investing in that news well before the news actually comes out, right? They're buying the rumor. The traders that often get caught up in the market, those are the ones that try to make their decision after the news comes out. So here could be an example, right? So what the market's going to be looking forward to tomorrow is not the interest rate hike, right? Everyone and their mama knows it's coming. Would you guys agree? Everyone knows it's coming. If you follow these fundamentals at all, everyone knows it's coming, right? So it's no surprise. So the question is, what is the market really paying attention to then? And what do you guys think that is? If it's not the interest rate hike, if that's already assumed, what is it paying attention to? The Donald. Future projections. So the big thing that the market's going to pay attention to tomorrow is there any type of statement, any type of announcement that the interest rate, we're going to get out of this hiking cycle? Are we going to stay aggressive? Are we going to start backing off and become more conservative? That's what the market's paying attention to, and that's what it's going to react off of. And we can very well see something like this, right? We can see an interest rate hike. However, in the FOMC statement, it could say that it could be a dovish tone, which means a less aggressive tone, meaning they kind of say, okay, well, we're going to sit back and really reevaluate things before considering if we're going to stay on this hiking cycle, which would be dovish news, and which would kind of go against the aggressiveness. And if that were to happen, do you think that would mean, you think that would be strength or weakness for the dollar? It would mean weakness, right? So we can very well see an interest rate hike tomorrow and see weakness in the dollar, and that would mess with your mind. Would it not? Wouldn't that be the weirdest thing? And the the first couple of times I ever saw that happen, I threw my textbook out the window. I'm like, what were you guys teaching me in school? But we can very well see that. We can very well see an interest rate hike tomorrow and see dollar weakness. And then we're going to get all the questions. Well, what? That doesn't make any sense. And it's because many of us are looking at the wrong thing. And that goes the same for any other type of news, right? Where we get a CPI report today at 8:30, and we may get a strong number and we may get weakness in the dollar. And the key is that the market, when it comes to news, right? The market moves on deviation, right? The markets move when the unexpected happens. So if the general consensus is that we're going to see a strong number and we get a strong number, the market typically doesn't move that much because, it did what it was supposed to do, right? You take a test, you study for it, you know you're going to get an A, teacher hands it back, you get an A, right? You're not really that excited. You're like, okay, well, I knew I was getting that. Big deal. However, when you have an expectation, right? When you study for a test and you think you know all the answers, and then you get the test and you find out that it's on a completely different subject than what you studied for, that's where you see kind of the panic, and that's when you kind of see the big movements in the market, when the unexpected happens. Does that make sense, guys? Our lesson about fundamentals. Yeah, so it's interesting, and that's why I've never been I'm not a fundamental trader. I've worked really hard. I made it my goal to learn more about them. I do understand their purpose in the markets, and it just interests me as well. But that's one of the reasons I find it difficult to be a fundamental trader. For those reasons, and again, there's a big difference between fundamental trader and investor. Investor is a different story because you're taking a much long-term perspective. I'm talking about someone that's trying to trade the market, like someone that's looking at the news today at 8:30 and saying, okay, I'm gonna make this short-term 15-minute chart trading decision off of the 8:30 news. I don't really see how you can consistently do that. Bigger picture, I can certainly see it. But trader is a little bit different. So, yeah, there we go. Good. Killed some time. We got nothing in the markets today, guys. So we killed some time with a positive lesson. That's